And he goes, the US dollar has been the global reserve currency. It is the global reserve currency, and it will always be the global reserve currency.
Wow.
Exact quote. And I said, David, I feel like I'm in Whitehall in 1913 listening to John Bowles say sterling is the global reserve currency and it always will be, etc. I said, you're blind, but hubris is a good word. In plain English, taking it for granted. I mean, if you take your status for granted, then you can do all kinds of crazy stuff and not worry about it. But you can't take your status for granted. You have to earn it every day. We got the trust. We started with the trust, earned, like I say, since 1791, but we blew it. And I've always said, and I told government officials this, I said, I don't really think our adversaries can destroy the dollar, but I think we can do it ourselves.
I agree with that 100%. And I think that brings me sort of, if I can jump to the next issue that I see with all of this is, while it doesn't directly threaten the dollar's role as the reserve currency in the way you lay out, because they still need to work on building markets that are deep enough that they can recycle all these surpluses into. But ultimately, it does threaten the dollar's reserve standing, because every trade agreement that is undertaken in something other than US dollars is vendor financing money to the US Treasury that's no longer coming in, which means there's only one natural buyer left, and that's the Federal Reserve. And QE, as I've said, since 2009, becomes a deficit financing necessity. It's not some discretionary economic policy. It becomes the law, and the Fed has to just monetize until eventually the dollar, buckles under the weight of all that, reckless.
And that's exactly right. And I would have said, and I have said, in discussing could China be the global reserve currency, whatever. And I don't have to repeat it, but I went down all the elements and mechanics of and hedging of a bond market big enough to be to absorb global savings. And the Treasury has that. And I said, China's not even close. China's not going to be global reserve currency for, I don't know, maybe never. They don't have any of those things. They don't have primary dealers. They don't have auctions. They don't have a large bond market. They don't have a rule of law. Neither does Russia. Who trusts the Russians? But then in thinking about the BRICS currency, I had another one of these like aha moments, like where a light bulb goes on. I said, oh, I was writing or something, doing some research on World War I. Basically the history of government finance of war is what I was looking at. And I saw this Liberty bond poster, and it was, Lady Liberty, Statue of Liberty with a torch. And she, instead of the tablet, she had like a Liberty bond. And she was like, come on, America, we got to win the war, buy Liberty bonds. And in my book, The New Great Depression, which came out in 2021, was half the book was about the pandemic. Half was inflation, deflation, but the other half was the pandemic. And one of the issues that came up, because I said, well, it's kind of a new pandemic, why don't I read about the old one? And I read like 4 or 5 books on the Spanish flu of 1918. And one of the vignettes was they didn't know until 1930 what caused the Spanish flu. They didn't know what a virus was really until the electron microscope. But they had a sense that it spread around. And so in Philadelphia in 1917, there was going to be this big parade to buy Liberty bonds. It was like a freedom, win the war pep rally. And all these doctors at the University of Pennsylvania and elsewhere were like, don't do this. You're going to get 100,000 people on Broad Street, and they're all going to die of the Spanish flu, in effect. And they went ahead anyway. They did it because for 2 reasons. One, that's how important it was. But 2, there was more extreme censorship under Woodrow Wilson than there is today under Biden. I know that sounds like can't be true, but it was. They were arresting people. You couldn't write a newspaper article about the Spanish flu because it was considered bad for morale in terms of the war. In fact, the reason it's called the Spanish flu is that Spain was not in World War I. They were not a belligerent. So their newspapers like, hey, we got this flu, and they were writing all about it. And the rest of the world's like, hey, I read the Spanish newspaper said they got a flu. So they called it the Spanish flu, even though Spain had nothing to do with it, but they were the only country that was allowed to talk about it. So, but what that did if you look at the history of, these are some old names. I'm just, been around a while. E.F. Hutton, Dean Witter, Merrill Lynch. When were these firms founded? It was around 1910, 1912, 1914, and a little bit later in some cases. But the Liberty Bond was the beginning of the retail investing market in the United States. Prior to World War I, U.S. wars were always financed by, like, big shots. Stephen Girard financed the War of 1812. Nicholas Biddle financed the Revolutionary War. J. Cook financed James Cook rather financed the Civil War. There these like dealers who did it, but that all changed around World War I. So my point being, there's an example, contrary to everything I just said about China building a top-down bond market, and I don't think they can do it. Here's an example of a bottom-up bond market, where you basically got retail investors to buy into these bonds. And if you get enough of them, you're going to have a bond market because somebody will start making a market in it. And let's say you go to a typical Brazilian and you say, hey, you got two choices. You can buy a Raiz denominated bond, or you can buy a BRICS denominated bond. What do you want?
What do you think? Yeah.
And then multiply that by the world. So that's not going to happen overnight by any means, but I think there is the potential for an indigenous bottom-up retail bond market in the BRICS currency for the reasons I mentioned, that over time, sooner than later, perhaps could give you something like a reserve currency status. So this thing is so well thought out, and they've even things that I would have objected to as recently as a couple of months ago. I said, well, it won't happen because I'm like, I've now modified my because. I'm like, no, actually, it could happen.
Yeah, no, and I think that context of how long they've been working in cooperation, and not just the amount of time, but the depth and breadth of the cooperation, and the fact that they're, like you said, they're coordinating on social issues, economic issues, geopolitical issues. And then I read in the piece you sent me about a submarine telecommunications cable that they're setting up. I mean, do you have any more detail on that you could share? I mean, that's just
I actually know a lot about it. But they've built their own fiber optic submarine cable. They call it BRICS cable. Because the US is very good at tapping these things. I actually did a job once where I had to figure out all the global telecommunications in the world through cable. It was a long story, but there's something called CWME, which is C is Southeast Asia, we is Western Europe, and ME is Middle East. So CWME is basically the cable system that connects Asia and London. And then there's a separate one that goes from London to States. I know where it goes. I can't say, but it has a nice home in the United States. And I know where the Middle East choke points are. And again, I won't say those, but the point is, if you cut that cable at one of those choke points, or you go off in somewhere in the Mediterranean and cut that cable, you shut down internet communications between Europe and Asia, like in a heartbeat, and by extension, the United States. More sophisticated version is to tap them. Easier said than done. Every now and then the internet will go out. I go, oh yeah, there's some problem with the internet. It's like, well, no, you're tapping the cable, and it'll be back up in a couple of hours. So the BRICS know this, and they are laying their own cables. Now, easier said than done in terms of protecting them, but they want to have encrypted, secure communications and payment channels. Again, they've been screwed over by the West. We kicked them out of SWIFT. We kicked them out of, other interbank payment systems. They ended Visa. Visa's no good in Russia. MasterCard's no good in Russia. The banks can't transact in dollars, certainly. Okay. This is the 12th largest economy in the world. It's the largest landmass in the world. It's the largest nuclear arsenal in the world, et cetera. But you're saying you can't be part of the international payment system. Well, there's a simple solution to that, which is build your own. Yeah. And that's what they're doing.
It's amazing. And I guess, they found a way around all of the infrastructure that we have in place that we have built over, basically centuries. And it looks like they're just going to leapfrog right into the digital age, both between that submarine telecommunications cable, but then also you see this BRICS currency really as a digital currency, do you not? Or, I mean, they're not going to issue tender. They're not going to have physical paper bills.
No, they're not. And you also it won't be a lot. The one thing I can say to our viewers is that this is not over. There's been a little bit of a sigh of relief. Stock market rallied a little bit toward the beginning of April, and okay, that's a normal reaction. But any thought that the problem's been solved, the bailout's complete, you're not going to hear more is just not true. There's more coming. Get ready for it. I can't tell you. I'm not going to, pick a specific name, and we all know the names of the big banks that might be in distress. I'm just saying that there are more dominoes waiting to fall. The really interesting part about this, and again, we can come back to the specifics, is that the dominoes falling is a good metaphor. It's, if you got 100 dominoes, you knock the first one, they're all going to fall. That's just physics. So how do you stop that? How do you stop that crisis? Well, you truncate, you drop a steel wall between two dominoes, and this one hits the wall and this one's still standing. But that's the bailout. The problem is each crisis tends to get bigger than the one before, which means each bailout gets bigger than the one before. My question, we now at the point where the need of bailout is bigger than the capacity of the central banks, that they've pulled all the rabbits out of a hat, played all their cards. And again, this goes back to what I did say about the Silicon Valley Bank rescue. It is the biggest bailout in history, and I can explain why. But if that's the case, and what else do they have? And then, so now we're dangerously close to the point where as the crisis gets worse, it's no longer, oh, gee, let's wait for the Fed to bail it out, or let's wait for the ECB to bail it out. You get to the point, I think we're there, where you say, no, these guys actually can't stop it. And you lose confidence in the currency itself. The crisis is the dollar itself, and the euro, goes along with that. And then that's the crisis. And there's no way to bail out a dollar crisis with dollars, because you're just pumping more of what people have lost confidence in. And then, then where do you go? And there are good answers to that. We've seen it, again, we've seen it all before, but you have to kind of take the timeline out to, 1,000 years, or, the 1350s with the failure of the Bardi and Peruzzi banks in Florence, to see how these things can really play out. So this is big. It's not over. The regulators will attempt more bailouts, but we're at the point where I think you can start to question the regulators themselves. The Latin American debt crisis, broadly defined in the early 1980s, that played out. The intense phase lasted about 3 years, 82, 83, 84. It wasn't until 1990 that we got around to Brady bonds, which were the ultimate refinancing technique. But the intense period lasted about 3 years. Come forward to 1998, long-term capital management. That was about 3 months. That was July, August, September 1998. SVB was 3 days or less. It was like Wednesday, Thursday, Friday, and done. And I talked to a guy, no reason to mention names, but runs one of the largest endowments in the world. And he said, Jim, we were moving $8 billion out of Silicon Valley Bank, but we didn't know, because, you get to close business Thursday. We didn't know until Sunday that the money was going to move. We got a confirmation on Monday. We did end up moving the money. But there was about a 48-hour period there from Friday to Sunday when no one knew that the wires hadn't been completed. The recipients didn't have them. It was just in limbo, and it worked out. One of the big crypto promoters, back one of the stable coins, actually it's USDC, had $3 billion in Silicon Valley Bank. And they talked about, all these small entrepreneurs and startups, they got 100 employees and 5 million in working capital, and that money's gone and they're all going to fail. There was something to that. But the fact is, you had Roku, Cisco, eBay. I mean, there were huge companies with multi-billion-dollar deposits in that bank. It wasn't all a bunch of little guys. And what Peter Thiel did, and he was right. I mean, I'm not criticizing him. He got his own money out, but he sent out like an SOS to Silicon Valley. He said, all of you, whoever you are, get your money out now. And a lot of people did, and that was that $40 billion. So, and I'm not sure if everyone knows the sequence, but on Friday night, March 10th, the FDIC took over Silicon Valley Bank. And they issued a press release, and they said, here's what we're doing. We're taking over. We're putting it into what's called a receivership. Anyone with $250,000 or less, your deposits are fully insured. No worries. You'll have your money Monday morning. And over $250,000, your deposits are gone. They didn't say frozen. They didn't say suspended. They said gone. And they gave you a receivership certificate, basically an unsecured printed up IOU from the FDIC, but not money. and it's a receivership certificate. And they said, hang on to them. We're going to sell assets. And as and when we realize proceeds from assets, we'll give you something. We'll give you distributions on these things. Don't know how much, don't know when. We'll do the best we can. Remember in the RTC days in the early 90s, it took them 2 years, and they were very efficient. I worked with them at the time, and that was it. Well, that's when I call the billionaire crybabies came out in force. Bill Ackman, all these guys. Oh, you got to save us, I'm like, well, you got to trade on Bill. $5 billion is not enough. But anyway, they pounded on the White House all weekend. Now here's something that very few people, almost nobody knew at the time, except the management, although they seem to be asleep at the switch. 97% of the deposits at Silicon Valley Bank were uninsured. And by the way, that's my new metric for assessing banks. You used to look at, working capital and debt equity ratios and, bad assets, governments. There are lots of ways to measure the health of a bank. But the most relevant way right now is, and this is publicly available, take the ratio of uninsured deposits to total deposits. 30% is comfortable. If you're like, 70% of my deposits are insured, which means they're not panicky. They're not necessarily going to run for the hills. 30%, okay, uninsured, but I have assets. I have that much cash or more. That's a comfortable ratio. When you get over 50, you're in the danger zone. Well, Silicon Valley Bank was 97% uninsured, which meant all the money was going to run, and it did. So that's a way, if you're looking at these big banks or any institution or your own savings institution, to look at it. But Silicon Valley Bank was a climate bank. Were they investing in startups? Yes. Were they investing in technology? Yes. But these were climate. These were green new scam startups looking at battery technology, chemistry, physics, to try to make a better battery. But not much improvement in the battery in 200 years, but they're working on it. Wind turbines, other sustainable fuel alternatives, et cetera. Again, I'm not for that if you like, if that's your field of research, but so much is subsidized by the government and then further subsidized by Silicon Valley Bank. And that's where the assets were. That's where the loans were, by and large. And so the White House is getting hammered, not only because of entrepreneurs, job losses. And by the way, we are in an election cycle here in the United States, but from the greenies who are extremely powerful. So that was Friday night. So Saturday, everyone's crying to the White House. Sunday night is 6 o'clock. By the way, mark that on your calendar. Sunday, 6 p.m. is when they tell you what they're going to do. The 6 p.m. Sunday, March 12th, they came out on Silicon Valley Bank. The following week, 19th, that was Credit Suisse. And then the week after that was something else. They always announce the collapse on Friday and they announce the relief on Sunday. So they have the weekend to work on it. So on 6 o'clock on Sunday, March 12th, 48 hours after the FDIC announcement, the government said, just kidding, the deposits are fine. They did a complete 180 under pressure from the Fed, the White House, et cetera. Even though FDIC did the right thing, legally, they said all the deposits are good, all of them. And then Jay Powell said to every member bank, not Silicon Valley, but every member of the Federal Reserve System, if you have underwater bonds, U.S. government securities, treasuries or certain mortgages, you can ship them to us. We will give you a loan at par value. We'll give you cash equal to par value, even though the loans are only worth 80 to 85 cents on the dollar, because interest rates have been going up for over a year. The value of the bonds goes down. That's bond math 101. Rates up, bonds down, prices down, rates go down, the prices go up. Well, the rates have been going up, so the prices are down. Here's the Fed saying, we'll give you 100 cents on the dollar for your 85-cent bond on a 1-year loan. So the loan was important because it means they didn't actually sell them. It was collateral for a loan, except you're under collateralized. And the Fed's like, okay. The banks are kind of saying, oh, that's good. That's a good deal. I'll take that. I'll do that myself. Here's something under collateralized. You give me the cash on a 1-year low interest rate loan. And now in theory, I've got all the cash I need to, pay depositors if they're taking the money out. But better yet, I don't have to record the loss. By the way, those unrealized losses estimate probably $800 billion in the banking system as a whole. So here's the Fed saying, we'll give you, 100 cents on the dollar, even though your bonds are worth 80. And you don't have to take the loss because it's structured as a loan, not a sale. So this is a multi-trillion-dollar bailout. It's legal in the barest sense, but it's an accounting game. It's a bailout game of unprecedented magnitude. The supply chain breakdown is causing a lot of the inflation we see. And everyone's like, wait a second, why are you talking about deflation? That's coming next. People are not ready for it. I know the inflation's here. I buy gasoline. I shop in the grocery store. I get it. It's persistent. It's not transitory. I understand all that. But inflation has two major sources. One is the supply side, which is called cost push inflation. So that's energy price shocks, fertilizer shortages, strategic metal shortages, component suppliers who can't deliver stuff to factories in Germany and they're shutting down, et cetera. The other cause is from the demand side, and that's called demand pull inflation. Basically, it's psychological. Consumers pull demand forward. They're like, hey, I was thinking of buying a refrigerator. I better buy it today because the price is going to go up in 6 months. And in the 70s, we had both. It started with cost push with the Arab oil embargo, but it ended up demand pull. I was starting my career at the time. Your boss would just give you a raise. You didn't even have to ask. Inflation was going up so fast. Like, I better give this guy a raise. Like, here's another, $30,000 or whatever, because people would quit, and that sort of spun out of control until Volcker squashed it all. Right now, we do not have demand pull inflation. We do have cost push inflation. The difference is hugely important because cost push inflation from the supply side, it's real, prices go up, but it's self-negating. The old saying that, the cure for higher oil prices is higher oil prices, because when they get too high, people stop driving. They shut down various activities. By the way, if you're unemployed, you're not buying any gasoline because you're not going anywhere. I mean, that's kind of a nasty way of putting it, but that's how the cost push inflation tips into a recession and then prices come down. And we saw that in 1974. You had Jerry Ford and Alan Greenspan walking around with they had these win buttons, WIN, which stood for whip inflation now, except we had a recession and prices collapsed. Now, it came back by 77 for a lot of reasons, but right now we don't have demand pull. We have cost push. It will go away when this economy goes into recession. And then we're going to be talking about disinflation and deflation, which are, kind of close cousins. And the Fed's going to be out on a limb as usual, raising rates in the face of a recession and a price collapse. I don't know what the recession is the cure for. It's coming. I mean, the recession is coming. And Jay Powell said this. I mean, Jay Powell gave two speeches, August 26th, Jackson Hole, and September 21st at the press conference after the FOMC meeting that day. And the September 21st speech was almost like, well, just in case you weren't listening to me in Jackson Hole, let me tell you again what's happening. And then Jackson Hole, he was like Nancy Pelosi. He tore up a speech and wrote a new one, like literally the day before. It was 3 or 4 pages. It was really short. He used the word pain 3 times in one paragraph. I've been following Fed news for 45 years. I've never seen the word pain ever. But he basically said the same thing. But September 21st, he was even more blunt. He said, there's going to be a recession. It's going to be bad. Unemployment is going to go up. Get it straight. These things are going to happen. And that's what it's going to take to get inflation under control. But he went on and on about how inflation was job one because the Fed has this dual mandate, which never made sense, but it's the law. I mean, Humphrey Hawkins, the dual mandate is price stability and low unemployment. Those two things don't always go together. And sometimes you got to make trade-offs between the two. But right now, the trade-off is very easy, which is unemployment's really low. Now, I don't put much weight on it, but the Fed does. Again, put your Fed hat on. Unemployment's really low. If unemployment went from 3.5 at the moment, if it went to 4.5, 4.9, is that the end of the world? Well, that was considered pretty low in 2013 when they were doing QE4 or whatever. So they're willing to do that. And they also think the recession, if it comes, will be mild, but those two things together will get inflation under control. I mean, and what Powell said, he didn't say that their target is core PCE, personal consumption expenditure, price index, core meaning excluding food and energy. And everyone's like, why would you exclude food and energy? Again, I'm not here to debate it. That's what they do. So they want to get core PCE year over year to 2%. It just came in at about 4.7, give or take. It just went up. I mean, it's not going down, but they're trying to get it down. Now, Powell did not say we're going to raise rates until core PC is 2%. He didn't say that. What he said was we're going to raise rates until it's acting in a restrictive way on inflation, and inflation will come down on its own because rates will be high enough to cause that, at which point we, the Fed, will pause. And you say, well, when are you going to cut rates? He was like, the pause could be a year. So you're talking 20, forget this Fed pivot nonsense. I mean, you're talking 2024, if then, before they cut rates. But in the meantime, so they've got to get rates high enough. So they're going to go, who knows, we'll know closer to the date. Some talk about 50, but it doesn't matter. I mean, it's going up, probably going to go up. You know, I have the calendar for 2023. There's a meeting in March, I think March 22nd. They're going to get rates up to five-ish. It's like I remember in Vietnam, the old saying, you know, we had to destroy the village to save it. We have to destroy the economy to save it. This is the latest in a long string of Fed blunders since 1913. Seems to be their specialty, but that's what they're doing. And then beyond all that is there's a brewing global liquidity crisis, a global financial crisis that's different from a recession. It's financial panics and recessions are two different things. They can come separately. In 1998, we had a financial panic, but there was no recession. In 1990, we had a recession, but there was no financial panic. In 2008, we had both. They can come together. It looks like they might be coming together again. This is revealed in inverted yield curves. Major dealers are bidding at auction for treasury bills. The Fed will give you treasury bills with a phone call. All you have to do is call the Fed and do a reverse repo with the Fed. They'll give you some treasury bills. But the banks are bidding at auction for treasury bills at yields of maturity lower than what the Fed will give you for a phone call. Why would you do that? The answer is the Fed bills cannot be rehypothecated. They cannot be used as collateral, but the auction bills can. So what that tells you is there's a collateral shortage. That means deleveraging balance sheets. It means financial distress. And we also see it not just in the treasury yield curve, which is inverted from right now 6 months to 10 years, but also the euro-dollar futures curve, which is even more troubling. It's not unprecedented, but it is rare, and it's not a good sign. But the Fed continues, you know, raising rates in the teeth of this really bad data. So I look for a severe recession in the U.S., really global, because it tells the global outlook is pretty bad. And then on top of that, possibly a global financial liquidity crisis worse than 2008. They could at least pause now, or maybe even cut rates. If everything I said is correct, and obviously I think it is, or I wouldn't be saying it, but if we're on the verge of a global liquidity crisis, as revealed by the euro-dollar futures curve and the treasury yield curve, and negative swap spreads and treasury bill auctions with the yield of maturity below what the Fed will give you for a phone call, I mean, all those things are happening. That's hard data, and it's a very, very troubling sign. Last seen in 2008, by the way, before the Lehman Brothers meltdown. If all that's happening, and the fundamental signs are also weak, which we saw in third quarter GDP, which is based on net exports, which won't last. How are you going to drive a trade surplus with the strongest dollar in 20 years? Good luck with that. I mean, nobody can afford our stuff, and we're not buying anybody else's stuff. So with the economy going into a recession on its own, with a global liquidity crisis brewing, why on earth is the Fed raising rates at all? That's not sustainable. So I would look for a recession, a more severe recession. That's one, combined with Fed tightening, interest rate hikes, balance sheet reductions, et cetera. That's one whole vector. And I wouldn't put any weight on a low unemployment rate. It ignores labor force participation rate, which is awful. It's down around 62% versus 70% in the year 2000. But beyond that, unemployment is a lagging indicator. Unemployment goes up after a recession begins. Employers are very reluctant to lay off employees. You got to pay severance. It's expensive to recruit and hire them back and train them. You pretty much wait until the recession has already started and you can, all right, I got to lay some people off. So it's not a leading indicator. It's a lagging indicator. So the Fed is behind the curve. The first point I would make is that global recessions are rare. Recessions in individual countries or economic communities like the EU do happen with some frequency, but a global recession is different. It's usually the case that even when a large group is in recession, somebody else is expanding. China, the 70s, 1970s used to call the U.S. the locomotive. If Germany was in recession, somehow the U.S. could kind of power through, although the U.S. itself had 3 recessions between 1974 and 1982. But a world recession is rare. We had one around the time of the 2008 financial crisis, even though Australia did power through it, okay, and certainly in 2020 during the pandemic lockdowns, but they're unusual. As I say, it's usually one group is in a little bit of trouble, but another group powers through and even can pull the recession country or group out of difficulty. But when global GDP declines, that's rare. We are heading for exactly that. To understand that, let's take a look at some of the largest economic groupings, and I'll start with the United States. Now, the United States had a mild recession in the first half of 2022. If you blinked, you missed it. First quarter GDP was negative, not a lot, about 1.6%. Second quarter GDP was also negative, about 0.9%. So first half as a whole, we had negative GDP. The rule of thumb definition of a recession is 2 consecutive quarters of declining GDP. That's the rule of thumb. We had that. It's in the data. Having said that, it was mild, and third quarter GDP and fourth quarter bounced back. But if there was a recession, it was mild. What I'm talking about is a much more severe recession, much more difficult, much sharper drop in economic output, beginning about now with rising unemployment, slowing industrial output, slowing retail sales, and importantly, for investors, a very sharp decline in inflation. So this is one of the kind of mystifying points about the U.S. stock market. I mean, it seems straightforward to me, but the market has their own dynamic. They're saying, well, if the Fed raises rates the way I've described and they cause a recession, the Fed's going to have to cut rates. That's called the pivot, the Fed pivot, and lower rates are good for tech stocks, so buy stocks. But think about that for a second. What if inflation comes down faster than the Fed thinks? And I think it may, by the way, I'll return to that. What if inflation comes down really fast and they get to the target rate sooner than they think? Does that mean they might have to cut? Well, it might, but what's good about that for stocks? I mean, if that happens, no one ever says, why did that happen? They just say, well, inflation may come down, interest rates may come down, so buy stocks. It's like, well, inflation may come down, interest rates may come down, but if it does, it's because we're in a very severe recession, exactly what I'm forecasting. And so if that's the case, stocks are going to plunge, 30, 40, 50%. So don't root for lower rates, or if you're forecasting lower rates, understand what that means. It doesn't mean the Fed chickened out. It doesn't mean life is wonderful and you should buy tech stocks. It means that we're in the very severe recession that I described, and I think we will end up there. And therefore, stocks are going to plunge. So, be careful what you wish for, as they say. My forecast is, yeah, they are going to raise rates. They're going to over-tighten. They're going to cause a very severe recession. And when they do, they may pivot at that time, but it won't be for good reasons. It'll be for very bad reasons, meaning we're in a recession and stocks have plunged. So don't buy into the Wall Street chatter as far as that's concerned. Because as I say, the Fed's going to over-tighten. Now, why doesn't the Fed know this? Well, because they never know, because they have the worst forecasting record of any institution I can think of. Their entire history since 1913 is one blunder after another. And this will just be the latest in a long series. And so just to kind of summarize, the Fed's on a course. We know exactly what it is because they told us. All you have to do is listen to them and believe them. They're going to raise rates, let high rates do its work, do their work, and see the inflation come down, and maybe in 2024 cut rates. What I expect is they are going to raise rates for the next couple of meetings, exactly as I've described, but they're going to over-tighten. The signs of recession are already present. The Fed's not looking at them. I'll come back to what they are, by the way. And we'll be in a very severe recession for a lot of reasons. And that's going to mean a plunge in stock prices. So if the Fed cuts rates, don't cheer too loudly, because it'll be in a world where a severe recession, higher unemployment, and crashing stock prices are the norm. I'd like to finish on can't call it a happy note, but global liquidity crisis. Now, I talked about a global recession, and people go, well, isn't that like your liquidity crisis? No. A recession or a depression is very different than a liquidity crisis or a financial panic. They're two different things. They can and do happen separately. In 2008, we had both. In 2008, a recession or depression and a financial panic converged. So they can happen together, but they don't have to. They can happen individually. What we're in for looks like a global financial crisis and a global recession at the same time, coming sooner than later. Now, why do I say that? There's a global dollar shortage. People go, wait a second. The Fed printed $9 trillion, which they did in 2020. It's come down since then, but they did print that much money. How could there be a global dollar shortage? Well, what people don't understand is that behind the curtain, off balance sheet, this is off balance sheet. You got to go read the footnotes and understand what you're reading. There are $1 quadrillion of derivatives. And for those not familiar with the Q word, 1 quadrillion is 1,000 trillion. So I just said the Fed printed $9 trillion. Maybe it's down to $7 trillion. Yeah. But you have 1,000 trillion dollars of derivatives. And they have to be supported with collateral. Not 100%, not even 10%. I mean, kind of 1% or 2% is enough. But when you're in a liquidity crisis, banks are extremely choosy about which collateral they'll accept to support this quadrillion-dollar inverted pyramid of derivatives. And right now, what they're saying, because this evolves, it gets worse. It doesn't happen overnight. It can become acute overnight, but it happens over the course of a year or longer. What we see, the banks are saying, I don't want corporate bonds as collateral. I don't want your mortgages as collateral. I don't even want 10-year treasury notes as collateral. The only collateral I want are short-term U.S. Treasury bills. Treasury bills have a maximum maturity of 1 year, 360 days, but there can be 4-week bills, 8-week bills, 6-month bills, etc. That's the best form of collateral. It's the most liquid, easily traded, low volatility, easy to repledge. It's by far the best form of collateral. That's all the banks want right now. But if you're a foreign bank, you need dollars to buy the dollar-based collateral. If you want treasury bills that are denominated in dollars, you need dollars to buy the bills. That's why the U.S. dollar is so strong. People go, wait a second. The U.S. has a multi-trillion-dollar annual budget deficit, a massive trade deficit, 132% debt to GDP ratio, $31 trillion in debt. You're going into recession. How can the dollar be so strong? The answer is everything I just said has nothing to do with the demand for dollars in international foreign exchange markets. What's driving the demand for dollars is the need to get dollars to buy dollar-denominated collateral, specifically treasury bills, to post as collateral to support the $1 quadrillion of derivatives. And that's going to persist until the system crashes, which it's in the process of doing. Supply chain is not part of the economy. Supply chain is the economy. In other words, if you want to understand the economy, you're really talking about the supply chain at every aspect. Something as simple as a loaf of bread. You buy a loaf of bread at the grocery store. Like, okay, well, I guess it came from a baker, and I guess they took it from the bakery to the store by truck. So there's a supply chain. Well, that's about as simple a version of the supply chain as you can imagine. You have to just start going from there. It's like, well, did the bread come in a plastic wrapper or a paper wrapper? Well, that wrapper came from somebody. Where'd the truck come from? Well, obviously a truck manufacturer. Where'd the driver come from? Somebody had to make a career choice and be trained. And what about the diesel fuel in the truck? That came from a refinery, and that came from oil exploration. Then you get back to the baker, and it's like, oh, well, I guess he had an oven or she had an oven. Where did that come from? And then you find out that the ovens are industrial ovens have parts from 25 different countries and so forth. Well, without belaboring that point, you get back to the farmer and the wheat and the fertilizer and everything else, and really what's called the extended supply chain. And you're like, wait a second, that's a huge number of countries, a huge number of imports, and a big part of the economy, which it is. And then every link in that supply chain I described has its own supply chain behind it to get to source materials and intermediate manufacturing and so forth. And then that's for a loaf of bread. Well, what about your car, your furniture, your clothes, and on and on and on. Once you start thinking about what supply chains are, you realize it's just the cardiopulmonary system of the entire global economy. So, the supply chain book shines a light on the entire global economic process. And I have whole chapters on that talk about China, the war in Ukraine, and climate change. And you say, well, the interesting topics, but what do China, Russia, and climate change have to do with the supply chain? Well, the answer is they are, kind of global macro earthquakes. Russia's invasion of Ukraine led to sanctions against Russia that affect everything, imports, exports, strategic materials, semiconductors, fertilizer, oil, natural gas, etc. Again, you're saying, well, okay, Boeing makes aircraft. They need titanium and aluminum. Where does that come from? Turns out about 30% of it comes from Russia. So how are you going to keep the Boeing assembly line going when you're shutting down strategic metals from Russia? I can go kind of on and on there. China, everyone says, well, they slowed down because of the zero COVID policy. And that certainly has been detrimental to their economy. Shanghai, a city of 26 million people, Beijing, a city of 22 million people, they were both locked down entirely last spring. When I say entirely, no transportation in or out, nobody on the streets. You had some essential workers, people had to get to work. You had to have a COVID test, a negative result that was not more than 2 days old. So these were extreme lockdowns and obviously very, very detrimental to the economy. Now, those have died down a little bit, and China's saying, now we're going to relax our zero COVID policy a little bit. So what's new? Why are supply chains breaking down? What's new about the supply chain that makes it different than any other period in the history of the world? And what's new were two things, and they arose around 1989. The first was you had a combination of increased computing power, algorithms, artificial intelligence, better data collections, and new models. So you suddenly had the computational telecommunications and data and mathematical tools to be a lot more sophisticated about how you handle the supply chain. But the second thing that happened at the same time was 1989, the fall of the Berlin Wall, 1991, the collapse, demise of the former Soviet Union, which gave rise to new trading partners in both in Eastern Europe, where they were no longer behind the Iron Curtain, Poland and Romania and Hungary and many other countries. And at the same time, you had the rise of China. China did have a fairly high growth period in the 1980s, but nothing like we see today. And it all came crashing down in 1989 with the Tiananmen Square massacre. And that really shut down U.S.-China relations, not fully, but there was no Western investment coming into China. The two countries were distant. Well, that ended around 1992. Deng Xiaoping did what he called the Southern Tour, where he reaffirmed China's commitment to capitalist principles. They weren't overthrowing communism, but they were embracing capitalist market ideas. There was a thaw in U.S. relations, and then it was like, no holds barred. Then that's when the U.S. investment really did pour in. So all in a short period between 1989 and 1992, you had the fall of the Berlin Wall, the fall of the Soviet Union, new republics. China kind of re-enters the game, and all this was globalization. So now all of a sudden you had the science I described, computing and artificial intelligence and applied math, and a true global market. So now the supply chains could go 9,000 miles from Chongqing to New York, or from Shanghai to Seattle, or London to Hong Kong, of course. So this was true globalization, much larger scale, much longer supply chains, and it worked. And so this was a period I call supply chain 1.0, 30-year period from 1989 to 2019. Now, why did it break down around 2019? Three things. A lot of people look at the pandemic and they go, oh yeah, COVID, that disrupted everything. That was the problem. And some people look at the war in Ukraine and the Russian sanctions and go, that was the problem. And they both made it worse. They both made it worse, no doubt about it, made the supply chain worse. But it really started in 2018 with Trump's tariffs on China. So Trump put tariffs on appliances and solar panels. Well, China didn't stand still for that. So China said, well, what can we do to strike back? Well, at the time, China was and is the world's largest importer of soybeans. They need the protein. They don't have enough. The U.S. and Brazil are the two largest exporters of soybeans. Well, China was buying all their soybeans from the United States because they were trying to reduce the trade deficit. We were buying so much stuff from them, and China said, well, what can we buy from the U.S. just to kind of balance the books a little bit? And the answer was soybeans. Well, when Trump put the tariffs on, China redirected all of their soybean orders to Brazil. They stopped buying U.S. soybeans and they bought them all from Brazil. Well, there's a lot more to that than a phone call. You got vessels and dry bulk carriers and transportation lanes and port facilities. And, if you're Brazil and you get all these orders, you got to get trucks to get the soybeans to the ports. You got to open up port facilities, et cetera. The point is, this is a major, major shift in global logistics just to change the order book from the U.S. to Brazil. Beyond that, people involved in this, they don't want 6-month contracts. They want 5-year contracts, or at least 3-year contracts. and they got them. And so now all of a sudden, China's buying all their soybeans from Brazil, but this scrambled global supply chains. Now, what are the U.S. farmers doing? We're still growing the soybeans. We can't sell them to China. Well, it turns out the Netherlands needed them. So, okay, we'll sell them to the Netherlands and distribute them to Europe, which they did. And then this went on and on because Trump put more tariffs on to retaliate. China took more actions against the United States, canceled purchase. So, and it escalated from there. Now, again, COVID made it worse. The war in Ukraine made it worse. But it's very clear that that's where it started. So that's why I use 2019 as just, kind of an arbitrary date with a 30-year period of supply chain 1.0. Now we're getting to supply chain 2.0, but we're not there yet. We're in this like messy, in between, inefficient, muddling through period where things are broken, but they'll never be put back together the way they were, but we haven't produced or created the new model supply chain. We're just muddling through, and with a lot of disruption, a lot of empty shelves. You have to understand, it took us 30 years to build this. We blew it up in about 3 years. It's not going to come back overnight. It's going to take 5 or 10 years or maybe longer to rebuild in some form. There are a lot of difficulties, a lot of challenges. We'll talk about all of them in detail.
Combination of wishful thinking,
people put words in your mouth and kind of get the reputation as this doom and gloom guy. Which point the response is always talking about the end of the world, which I don't. I never thought you use that expression. But I make the point that despite the difficulties,
that we are looking at a
have to be
potential
victims. We're not helpless. We don't have to crawl up in a ball.
And indeed,
the key is to see it coming. If you can see things coming, you can deal with them accordingly. You can get through them, not only preserve wealth, but actually make money. I always point out the example of Hugo Stinnes. People go, who's that? He was an industrialist in Weimar, Germany in the early 1920s.
So this would be the
and he could see the hyperinflation coming long before the middle class, long before anybody else. He went out and borrowed an enormous amount of Reichsmarks. That was the currency at the time. And just bought industrial assets, coal mines, vessels, natural resources, etc. So here comes the hyperinflation. He gives it a little time. He pays back his debts. I would say pennies on the dollar, like a millionth of a penny on the dollar. In other words, he paid it back. Sweeping the money down the sewers, but he paid back his debts and kept all the assets. And he became the richest man in Germany. And my German's not very good, but his nickname was Inflation's König, which means the inflation king. So there are other stories like it, Joseph Kennedy in the 1929 crash. But here's a guy who lived through the greatest hyperinflation of any modern industrial economy and ended up as the richest man in Germany because he saw it coming and made the right move. So again, we're not helpless. We can do things about it. The key to empowerment, as I say, is to see it coming. That's where the analysis comes in. And you're like, geez, Jim, you're smarter than everybody else. Of course not. There are a lot of big brains around, but people have flawed models. They have there's a lot of behavioral psychology behind it. The confirmation bias or believing the future will resemble the past, which it usually does not. And so if you're going to stick to those models, you're going to get really bad results. It's hard to think of an institution that has a worse forecasting record than the Federal Reserve, the U.S. Federal Reserve. Possible exception to the IMF, they're both pretty bad. I mean, you could almost take the Fed forecast, do the opposite, and be just fine. There's more to it than that, but they just stick to these really bad models. But if you understand how the economy really works, if you understand it's a complex dynamic system, all I've done is I've taken complexity theory, which has been around for a while. I mean, you can say 13 billion years because the Big Bang was the ultimate complex dynamic. But the science of complexity, understood in mathematical terms, really goes to kind of the early 60s, but it's been used very successfully in physics.
How the SDR is already
National Laboratory worked
system.
with
The United States Treasury got
it has a lot of applications.
Provide
all I did was bring it over to capital markets. I looked at capital markets.
This was legislation passed
here's one of the most complex.
So what did the IMF do with the money?
Well,
what they did
there's nothing more complex than the human
if you look
brain.
at the total
so you're
IMF
putting
loans
humans on top of capital markets. You got complexity squared or some exponent, and those models work brilliantly.
Only
but try getting anyone to understand it or
I leave it
do
to you
work
to
is
decide whether the
difficult. But
president
again, the point is, if you have the right models, now it's behavioral psychology, a good dose of history, complexity theory, and two other branches of applied mathematics, you can get very good results. But if you stick to
more than
the Phillips curve and non-accelerating inflation, unemployment rate, and a lot of other nonsense the Fed uses, you're going to get it wrong.
Third outcome is the gold standard. I'm just going to go through this very quickly.
Came into long-term capital management in 1994 before the launch, so it was
you have to ask yourself a couple questions when you set up a gold standard. The first one is, what's your definition of money?
But
we have
was
zero,
the
M1,
lawyer. And
M2.
I'm not
These
washing
are
my hands
technical
of the risk
definitions. They're all
management and all
different.
that.
So you have to
we
pick
work side
one
by
of
side
those
with
to
these
be your
guys.
money.
Myron,
The second
on a
one is
quiet
what's
day,
the
Myron
proper
Scholes,
reserve ratio? Do you
Nobel
need
Prize winner in
100 cents on
economics,
the dollar of gold
co-inventor
to
of the
back all
Black-Scholes
the paper money?
formula,
A
which
lot
is
of
the
gold bugs
basis
would
of
say
$1
yes.
quadrillion
Historically, that's not
of
true.
notional value derivatives in the world. By the way, for people not familiar with the
20% back in the
1
United States
quadrillion
was
is
the 20th
1,000
century
trillion.
was on the gold
So
standard
that's
with
how many
40%
derivatives,
back.
balance sheet
So history
derivatives we have.
says you
But
can have
Myron
20 or
invented
40%
that
backing,
formula that set
and
the
that
base
works
of
just
all
fine.
of it.
The
Really
thing
nice
is
guy.
which
And I used to
nations
sit at
are
my desk and he'd
included.
walk
The
in, I had a
simplest way to
whiteboard.
understand that
And
the
I would
U.S.
ask him
could do
some
this on its
dumb
own,
question
but it
about
would
the
be a
markets. And
blunder
he would
because
sit
if we
there
had
and give
a
me like a
gold standard,
2-hour
a dollar
tutorial.
backed by
So
gold,
can you imagine
and
getting a
we were the
private
only one
2-hour
doing it, all
tutorial
the
from
other
Nobel
countries in
Prize
the
winner?
world would
So
essentially
yeah,
be
I
worthless.
was
Nobody would
around
want
when there weren't that
anything
many of
other
us,
than dollars,
but
which would be
I was sort of a lawyer,
extremely
very focused
deflationary
on
because the
that,
other currencies would not
compliance,
be.
you know,
Sorry, but we would
contracts.
repeat
I
the
wrote the
blunder
derivatives
Winston Churchill made
contracts, so I was very
in
immersed in
1925.
all
So we'll
that.
look at
But I was
what
kind of
those
comfortable putting my
criteria, look
money
at
with the
actually where
firm
the
and
gold
putting
is.
money I'd
If you
made
take the
previously.
17 members
You
of
know,
the
even the
European
guys who didn't
Monetary
win the
System,
Nobel
those who
Prize
back
at
the euro,
160
they have
they were the real
10,000
deal. They
tons.
were,
The United
you
States
know,
has
one of them was
8,000
the
tons.
youngest
The IMF has
professor,
about
youngest
3,000
full
tons.
professor in the
You see
history of
China,
Harvard
Switzerland,
University,
kind of tails
and
off
the
after
vice
that.
chairman
So
of the Federal
the good news
Reserve,
for the U.S.
2
and
Nobel
Europe is we
Prize
still have all
winners,
the gold. We think we will
you know,
have the largest
JM,
force
John
by
Meriwether
far
was
if there is
legendary
a
on Wall
new
Street. So
international
that was
monetary
the crowd.
conference.
So I
With
was
one
at ease
footnote,
about
which
the
is
money.
China
Just
is
very much
non-transparent,
focused
so
on my
that
job.
China borrowed
And then when
1,000
it all
tons,
fell
probably
apart in
closer to
1998,
4,000
I always
tons. We'll
say
probably
in the
learn
U.S.
that
system,
a year
it's
from
true in
now
the
when they
UK
update
also,
their
when things
figures.
really,
So China has
really
bought
go
themselves
bad,
a very
they
big
hand it to
seat
the
at the
lawyers.
table.
Like, hey,
So the first one,
I
the
can't
global
deal with this.
money, global
Give it to the
M1,
lawyers. And so
40%
you could be a
backing, that's
bankruptcy
about
trustee. We did not go into
$7,000 an
bankruptcy.
ounce.
You know, a
That's what the
negotiator,
price of gold would
bailout
have to be
expert,
to
you know,
support the
many,
money supply
many people
without
specialize. So I
deflation.
got the whole
So it's the
thing handed
non-deflationary
to me,
implied
and then we
price of gold.
organized it,
Global money
got
supply,
through
global
it.
M2 with 100%
We
backing
were
is
able to phone the
$44,000 an
runways
ounce.
and
The last scenario is
like 4
collapse,
engines
which I actually
flaming,
think is the
kind
most
of bring it in
likely
for
through a
a soft
combination of
landing.
wishful
We were
thinking,
hours
denial,
away
delay,
from closing
misapprehension of
every
statistical properties of
exchange
risk
in
and
the
bad
world
policy will
sequentially.
probably
We
just
started in
blunder into a
Tokyo,
collapse,
got term
at which
sheet on
point
a
the response will
Wednesday,
take the form
5
of
days. Nobody
executive
slept.
orders.
Nobody
For
slept.
social unrest,
You know,
probably
in
some
big law
kind
firms,
of neo-fascism.
I was
The way to
working. We
understand
had a
it, we have
base at
inflation and
Skadden Arps.
deflation going on at the
My
same
office
time.
was up in
Two
Greenwich, but
opposite
I was
ideas
back and forth.
happening at
You know,
the
so
same
the first
time.
day
The
everyone looks like a
deflation
lawyer.
is natural.
Second
It's
day
what
the ties
happens
come
in the
off.
depression
You know,
because
third day
of
the jackets
deleveraging.
come off
So
and the shirts
what's
are unbuttoned
deleveraging?
down in
Well,
the
I have
middle
to
of the
sell
chest. No
assets
one's
to pay
showered
off
or
debt. When I
bathed
sell
or
assets, it
whatever,
tends to
and it
depress
just
the
gets
price.
grubby, but you
I
sort
pay
of
off the
power
debt,
through it
prices are
and
going
get it
down,
done. And
so
we
now
did
I
on
can sell more
late
assets
on a
to pay off
Sunday
more
night
debt,
before
et
Tokyo
cetera. And you
opened.
get
But
into
if it
a
had
debt
fallen
deflation
down and it
cycle
came
until
close,
you've
Tokyo
liquidated
Stock
everything,
Exchange would have been
prices hit
closed, and
bottom,
then
and the economy people
Singapore
start looking around
and
for
Paris and
bargains again,
London
and the cycle
and New
starts to
York,
turn.
they would have probably reopened a few days later, but it would have been a shock like nothing since the Great Depression. So, but the problem is we did get through it.
Inflation
And two
coming
things.
from
Number
policy.
one,
What's actually going on is we have
24
sort of
years
a
ago. So
notional
people
5%
25 years ago almost.
deflation
So
and a
people are kind of
notional
fuzzy on it.
5%
You know, if you're
inflation,
under
deflation from
40, it's
deleveraging,
probably
the
like a
inflation
footnote
from
in some
policy, and
economics
they're
book or
pushing
whatever.
against each
But
other.
we were
and they're
looked at
canceling
by
each
the
other out.
SEC and the CFTC.
But it's not stable.
and,
You've
you
got
know,
these
there were
two
no
forces, and
lawsuits,
one of them is going to
and,
prevail. It's going to
so
snap.
we kind
It
of
could snap
got
either
through it all.
way.
I mean,
It could go into
interestingly,
much more
some of the
rapid inflation
principles
or much
after
more
long-term
serious
capital,
deflation.
you know, you
Kind
pick
of the
yourself up,
monetary
you dust
policy
yourself
roots
off.
of
They
this.
started new
Here's
companies and made
the
$1 billion.
basic statement,
So
the
they had the
quantity theory
talent. We just
money.
had,
You all
had
learned
a
this in
very,
the first
very
week
bad
of
patch. But I sort of
economics,
looked
but
at it
it's the
myself
equations
and said, well,
MV
wait a
equals
second.
PQ.
These
M
people
is your money
really were who
supply.
they said they
V
were.
is
They
the
really were that good.
velocity.
And yet
Velocity
they
is just the
had this
turnover of money.
disastrous
So,
outcome.
you know, I go to the bar
Massive
tonight,
failure
and
risk
I leave a
management.
tip, and
They're
the
not
bartender
dumb. They're
takes
not
the tip
venal,
and
but
takes
they
the
must be
taxi
doing
home.
something
The taxi
wrong. I don't
driver
mean
takes the
in the
fare,
moral
puts
legal
gasoline
sense. I
in
mean,
his
there
car.
must be
That
something
dollar
wrong
has
in the
velocity
model,
of 3
in
because
the
$1
way they
supported
understood
$3 of
markets,
goods and
or
services,
you wouldn't
the
have
tip,
ended up that
taxi,
way.
I guess.
So I sort
But
of,
if I stay home and
continued
don't
my
spend any
career.
money, my money has
ran
velocity
stock
of
exchange
zero.
after that.
So,
I,
and I
was
remind people,
not long
$3
after
trillion
9/11, I was tapped
times
by the
zero
CIA
is
and,
zero.
you
In
know,
other words, if
did
you don't
that
have
for 10 years.
velocity, you don't
But
have
I
an
never
economy.
got over this.
So basically,
What were
money
they missing?
supply, how much
So then
money
I
is there,
just kind of
times
on my own
velocity, how
time,
quickly
in
is
my
it
own
turning
way,
over,
I started
equals the
exploring
nominal
what
GDP,
could be wrong with the
gross
models, what
dollar value of all
assumptions
the goods and
were,
services in the
you know,
economy.
odds with the
And
facts.
nominal
How
GDP
did
has two
models
parts.
actually,
Q
sorry,
is
how
the
did
real
markets
part,
actually
and P
work,
is the price
and what
index.
models did
So
work? I started
inflation or
writing on that,
deflation.
lecturing
But
on
this is
that,
psychological.
because
They
of
have to
my
basically lie
national
to you. They
security
have to
work.
engage
I
in
got tapped
propaganda
to go out
bend
to
the
Los
velocity curve
Alamos,
to make you
Alamos
want to
National
spend more
Laboratory,
money than
and
you're
that's
actually
like,
doing right now,
good luck
so that
getting
they
in.
can get the
That's
nominal growth.
that's harder to get in than any other place I've ever
how do you
been. But
bend the
sort of
velocity
Mesa,
curve? What is
working
the
with
policy
people who
here?
are
And as I mentioned,
simulating
this is an exercise of
nuclear
propaganda.
explosions
Two ways
in
to do
computers,
two
supercomputers,
tools.
because you can't
The
blow
first
things
is
up
negative
anymore,
real
but we
rates.
still have to
Negative real
do
rates
weapons
is when
development.
inflation
I
is
was
higher than the
meeting with
nominal
them to
rate.
collaborate
That's
on
good because
taking
if you're a
that
borrower in
branch
that
of
world,
physics
you
and
actually pay the
complexity
bank
theory and
back
bring
in
it to
cheaper
capital
dollars.
markets. So it was
That's better than
interesting.
zero
I would
interest.
say
That's the bank
something like,
paying
I
you
did say
to be a
this, I would
borrower.
say, you know,
So ideally,
if we
the Fed would
had
say, we'll have
used what we
2%
call team
on a 10-year
science
note
or
and 3%
interdisciplinary
inflation, negative
approaches,
real
as
rates
if
of
we had some
1%. That's a very
physicists,
powerful
applied
inducement to go out and
mathematicians,
borrow. The other
economists,
thing they want to
a
do
lawyer,
is deliver an
behavioral
inflationary shock.
psychologist,
If I promise
maybe
you
an artist,
2% and I
don't know,
deliver
just a group
2%, There's no change in behavior.
And the physicists were like, great idea. Let's put it together. Let's make a proposal. Let's get the funding. They love that. But you would go to an economist and say, well, would you like to join this team? They would say, well, you have nothing to teach us. Why would we want to work with
do whatever?
physicists?
So that changes behavior. So 3%
interestingly, the biggest impediment to improving economic science were the
negative
themselves,
interest rate,
because they're so
drenched
and
it's also inflation shock,
I guess, in their own models, most of which are
and the
mistaken,
idea of 3% inflation is to get the borrowing, lending, and spending
machine going again. I just
try to
started
get nominal
building
GDP
my
back
own
to
models and
trend,
working
make
with
it self-sustaining, draw policy, substitute real GDP for nominal GDP, get real GDP back to trend, and we all live happily ever after. This is what the Fed is trying to do. They're going to fail, but it's important to understand what they're trying to do, why they're trying to do it. Then when you see them failing, it's very easy to forecast monetary policy because they're just going to do more of it till they get what they want. Why do they have to get this? Well, why do they have to have inflation? What's wrong with a little deflation? Well, here's what's wrong with it. This is actually the Fed's worst nightmare. The government, in economic theory, inflation and deflation, prices are going up, prices are going down. So what? You get a raise or you don't get a raise, or you get a little benefit, or they're winners and losers. It would seem like a normal economic process. But the government's view of inflation, deflation is asymmetric. They have to have inflation. They cannot have deflation. They can't tax it. So imagine you make $100,000 a year and your boss gives you a $10,000 raise and prices are constant. Okay. So you just had a $10,000 increase in your real standard of living. You got 10,000 more and prices are the same. Except what happens? Well, the government comes along and takes half. They take 5,000 and you get the other 5,000. But imagine an opposite case. You're making 100,000 a year. You don't get a raise, but prices drop 10%. Well, you had the same $10,000 increase in your standard of living. Your salary didn't go up at all, but the price of everything you buy went down, so you're better off. Except that now you get to keep the whole $10,000 because the government doesn't know how to tax deflation. So deflation can increase the real standard of living of the American people, but the government won't allow it because they can't tax it. It destroys tax revenues.